Hello everyone. Volume spread analysis strategy number 3. Make sure you read the book Master the Markets in lesson 1 before you use these strategies. You can apply this strategy on gold, GBP USD, Euro USD, AUD USD, USD JPY, USD CAD, New Zealand USD, and also sometime in Bitcoin, oil, or other instrument. The chart time frame you use in Asian session is 1 minute 5 minute. You use 15 minute and 5 minute in UK session, and you use 15 minute and 30 minute in one hourly session. Make sure your stop loss on trade should be 50 or below 50 pips. If any trade having stop loss above 50 pips, don't take trade. Okay. Again, the broker we are using for reading these volumes are ExyTrader. This is ExyTrader on mobile setup, demo account. This is ExyTrader on MT4 setup. And if you are using TradingView, then you should use the broker of Wanda to read the volumes. Now this is very simple strategy. This is one candle ultra high volume type strategy. And you see, look at this. There is a buy candle with a very ultra high volume. This is a 5 minute chart of gold, and you see a ultra high big volume, ultra high volume, massive volume, which is greater than previous all volumes. And you see a sell candle engulfing that volume, and sell candle have a lower volume. This is very important. The sell candle have a lower volume, half of the previous volume. That is very important. The sell candle have a low volume, and the buy candle have a ultra high volume. And the size of buy candle is very small, not a big buy candle. And the size of sell candle is very large, engulfing the sell candle with normal volume. Now it is a sign of sell. You have to sell it, and you have to place stop loss above, and you can get 1:3, 1:4, 1:5 risk reward on this trade. Okay, basically what happened, that market's gone up in this buy candle. There was an ultra high volume, mean some players, professional traders, institutional traders, market big operators, and big money, big players, smart money was active at this candle, buy candle. And what they are doing, we have to wait to see the reaction of that bullish candle. When market reversed back down, that means that on this bullish candle the big players were selling. Majority of big players were selling. That is why the next candle did not close to the upside. That next candle basically closed below the low of buy candle, and that is confirming that this whole scenario is bearish. You have to sell it, you have to place stop loss above, and you should expect 1:3, 1:4, 1:5 after that. Again, this setup forms when there is this setup form mostly few times this setup form on top, but it's very good if a top is already in place and this setup form in between. Okay, now again market has already bottom below and market is going up, then suddenly a very ultra high volume or sell candle. Look at the ultra high volume or sell candle, and the market reversed back, engulfing the sell candle, buy sell candle, ultra high volume sell candle. Market next candle is strongly bullish. Okay, now the volume or buy candle is lower than the ultra high volume. You just simply buy it, place stop loss below, and you can expect 1:3, 1:4, 1:5 activity. This is one hourly chart of gold. Okay, so this is the setup. This is the pin bar type ultra high volume candle, pin bar type ultra high volume candle, and you have to wait for the next candle. If next candle is engulfing strongly, closing above the high of previous candle, and whatever the volume is, volume should be lower than the previous candle, then you have to buy there. You have to place stop loss below, and you have to expect 1:3, 1:4, 1:5. Okay, again there is bottom already in placed. There is a buy trend in the background, And look at this candle. This is a sell candle with an ultra high volume. Mean professional players, big players, smart money is active here. And sell candle, smart money always buy in the sell candle. Smart money always buy on sell candles, and you have to wait for the next candle. When market reverse back and closing above the previous candle, you should buy there. And after most of the time in the such cases where this is a two bar reversal type setup, on this two bar reversal setup you will see market start ranging up down up down up down, and this is ranging, and there is a low volume in that range. You will see low volume in that range. That means that the supply and demand imbalance is now created, and now the ultra high volume came in the market, basically have created the demand in the market, and supply is basically overcome, and now demand is overruling the market. And this range is also is an evidence that the imbalance of supply and demand is created. Now demand is in control and supply is on the lower side, so market will start going up. And as soon as market break out this range with low volume or whatever volume, you should buy there. You should place stop loss below, and you should expect 1:3, 1:4, 1:5. Even if you buy on this buy candle to two bar reversal buy candle, still you will okay, you should buy there. You should place stop loss below, and you should expect 1:3, 1:4 activity. This low volume range, sometime it came, sometime it will not come. Okay, depends on the market. If it comes, then okay. If it not coming, then straight away buy there. Okay, now again the market is coming down. This is 15-minute of gold chart. Market is coming down. There's a two ultra high, there is a one sell candle with an ultra high volume. Look at the candle, and suddenly market start reversed upside within a low volume. Okay, so this is a two bar reversal scenario within, while the first candle have a ultra high volume or sell candle, and too much buying from the players actually change the whole scenario, and the supply or retail trading selling were absorbed aggressively by the buyers from the institutional trader or big traders or big players, and market reversed to the upside with a low volume. Now you have to buy there. You have to place stop loss below, and you should expect 1:3, 1:5, 1:10. After that, do not buy, because there are massive candles and the whole set up range is 200 pips. If this buy candle is very massive and you are buying there and you have stop loss here, then 200 pips stop loss is not affordable. So you should ignore such setup where there is a 200 pip or 150 pip stop loss. Stop loss should be 50 pip or below 50 pip. Now this is another setup where market have a two sell candles with an ultra high volume. Okay, and now market reversed back, jump up, closing above the above this high volume box. This is a pin bar, clearly a pin bar. Okay, and this pin bar is nullified by this bullish candle, and bullish candle close above the territory of previous ultra high volume pin bar. Now volume is less than the pin bar volume, that is ultra high volume. You just need to buy on this pin bar. If it is if green candle closes above the high of pin bar, you just buy there. You place stop loss below, and you should expect 1:3, 1:4, 1:5, whatever you want. You will get a very good trade on such type of scenarios. Now again market, this is a 30-minute chart of crude oil, and the market was going up. Suddenly market dropped. Then you see a small candle, a sell candle with an ultra high volume, a volume which is greater than the previous 10 to 15 volumes, and this is M30 chart. And then market quickly jumped above and closed above the high of previous sell candle, which was of ultra high volume. The jump of the candle which jumped above the close of previous high volume have a normal volume or a low volume. So you should buy there. You should place stop loss below, and you should expect 1:3, 1:5. After then in market you got the 1:5 as well. So this is a buy scenario. Now again market is going up. This is a Bitcoin chart of 1 hourly chart. Market going up, then suddenly a pin bar or doji or shooting star type candle on the top, green candle on the top. You can say it is a doji or shooting star or pin bar, whatever. It is a ultra high volume one candle. Then you should wait for other candle reversed back downside below the almost low of the top bottom of pin bar, and the volume is associated on it is very low, so you should sell it here. You should place or stop loss above that, and you should expect 1:3, 1:4, 1:5 activity. Obviously on this sell side, the players, the market makers who are operating in the market, who closely watch the market, they saw that previously on bullish candle there was big players were selling, and they were does not watching the market, and they does not think that big players, institution, smart money does not think that price will go up. So they are actually selling there, and by watching the market condition of market maker who are closely watching the market, they actually remove their sell liquidity from this here. They remove their sell liquidity from there, and buy liquidity from there. They actually remove their buy liquidity from there, and when they remove their buy activity, market is coming down with low volume because they have no buy orders in front of them, and market easily coming down because the path of least resistance is now downside. So that's how market door back convincingly downside, and you got, if you got a trade at this point with stop loss here, you got easily a 1:3 risk reward trade. Again market, this is a 30-minute chart of Bitcoin. Market was going up, suddenly a pin bar type, shooting star type, a small candle, bullish candle with a massive ultra high volume. Then next bar actually closing below, engulfing the previous pin bar candle. That shows that, and the low volume shows that market maker is clearly know this situation, that market maker who was providing the liquidity to both sides, they now not providing the liquidity too much and not have a buy orders in front of it, because the market maker knows that price will go down, and he will get lower rates to buy. Okay, because he is buying there, he will get lower rates to buy, so he removes his liquidity from that situation, and that's why market coming down with low volume, because there is no big orders in front of it. Okay, no resistance in front of it. So market slowly drifting down. So the ultra high volume on bullish candle in a small candle is a very sign of reversal, especially in a green candle, and clearly suggesting that big players, smart money is actually selling at that place where all the other participants like retail traders were buying, and the both buying and selling overlap together, and the supply that was injected by the big players actually now dominating the demand, and that domination of the supply from demand was closely monitored by the market maker. And what market maker does, they actually remove their buy orders in front of this sell candle, and market start going down. So you just need to wait for the bearish engulf covering the previous candle, ultra high volume candle. You just sell it, simple as that. Volume should be lower than the previous ultra high volume, at least half or lower. Now again, this is a chart of Bitcoin GBP USD 1 hourly chart. Market is aggressively coming down aggressively. Then a point came in when market was going down, but there was a ultra high volume coming in. You have to wait. Then market start ranging, and the range was actually of a low volume range. That suggests that market actually changed from selling pressure to buying pressure, and now the supply that was coming there by the retail traders is actually completely absorbed, and now the demand is actually lifting upside, and now there is no pressure of selling pressure left. And now market maker also is watching this whole situation. Market makers are not interested to put their sell liquidity there, and they are actually removing their sell liquidity. They know that price will go up and they will sell at higher prices, so market makers reacted to the market situation, and they remove their sell liquidity. That's why the market is going up with a low volume, and that is a perfect buy signal. You should buy there any buy candle and place stop loss below there, and you should expect 1:3, 1:4, 1:5 easily. Okay, that is very powerful setup, very powerful setup. Again, this is a British pound chart, where 1 hourly chart, there is a small buy candle with an ultra high volume, means something happened here, either buying or selling by smart money. And mostly in buy candle, smart money were selling, and the next sell candle confirmed the scenario that there was actually that was actually selling. Then again on buy candle there was ultra high volume. Look at the volume of that is ultra high volume. Then then the sell candle have a very low volume, so that means, and then the stock market start ranging with the low volume. That means that's now imbalance of supply and demand is now done. Now supply is clearly overruling the demand, and now the selling by big players is now overruling the whole scenario, and now there are no buyers in front of it to challenge this supply. And the market maker who were closely watching the situation actually cancelled all their buy liquidity, and now market is ready to go down, and market start going down, and you got the trade from there as a sell trade. When it break below the range, you got the sell trade. You should place stop loss here, and you got the 1:3 here. So that is a very powerful sell setup. Okay, now this is the pound USD chart. Again, 1 hourly chart. There is a support into the left side. You can project that, and again exactly on that support there is a doji type, pin bar type ultra high volume candle. That look at this candle size. This is a doji candle and an ultra high volume on it. And now check out the next buy candle. This look like a morning star as well. Look at the next candle, which is closing above the top of doji candle. So that means that player who were buying at a doji candle now are in control, and slowly market volume is drying up as well. So that means that market makers are also responding to the situation. Now this whole case is actually the buying scenario. You should buy there, you should play stop loss below, and you should expect 1:3, 1:4, 1:5 accordingly. This is a morning star type pattern. Okay, and there's the evening star reversal pattern there as well, but there is no UHV, no ultra high volumes on this the setup, so we will not play this to the sell side, because on this pin bar there is a no ultra high volume, so we will ignore this, but we will not ignore ultra high volume. Okay, now this is British pound 30-minute chart. This strategy works well on British pound. That is why I am repeating my British pound chart, British pound USD charts time by time. There is a Y candle with an ultra high volume. Then you saw the reaction that market closed down below the ultra high volume buy candle. You should sell there simply, and you should place stop loss above the high of ultra high volume candle. Now market turned back up, still there was a ultra high volume, then market again dropped and closed below the whole 4 candle ultra high volumes. Okay, so this is a sign of aggressive weakness. This is a second sell you can take, and now you can place stop loss above that, and you can have 2 sell setups there collectively. Now you can hold these 2 sell setups, and you should place stop loss above this whole box, and you should expect 1:3, 1:4, 1:5. This is a very powerful sell signal, because smart money is very active on these 4 candles. This is a 30-minute chart, so smart money was very active on these 2 hours, and you have to judge it by looking at the candles, and you just need to wait for the close below the high volume box. Especially you can just sell at engulfing pattern, which is covering the whole buy candle, both buy and ultra high volume buy candles. You can just sell it here, you can place stop loss above that, and you can expect 1:3, 1:4, 1:5 after that. Okay, on sell candle there was a low volume, now less than the ultra high volume candles. Okay, now this is a British pound 30-minute chart, and there is a previous support here, and market came down. There was a one candle with the ultra high volume testing that support, then market reversed back, closing above the high of the previous sell candle, suggesting that market players are actually active there, and now they converted the the selling into buying. Market is now in a bullish momentum, because these sell aggressively, selling that was coming there by any supply generated from the retail traders were all absorbed by the big players, and now big players have created so much demand that candle of bullish candle close above the top of sell candle. This 2 bars reversal is enough for you to take a buy trade, and you should place stop loss below. And if market start ranging, that's very good sign. That means that you have really market has actually changed the phase. The market is in imbalance phase where market demand is overruling the supply, and when market break out there, you can take another buy entry here. So you will get a 1:2, 1:4 risk reward on this trade. That's very important. You should these two bar reversal type candles, you should have a ultra high volume on sell first candle. That is very important. Then engulf have a low volume. That's also important. Engulf have a low volume as compared to the previous candle. Now this is British pound 30-minute chart. Look at this. There is ultra high volume on bullish candle, and the next candle sell candle is closing below, have a low volume than the ultra high volume, clearly suggesting that sell here, place stop loss above, and expect 1:4, 1:5 on this trade. And that was very clear setup. Candle size was also small, which is very powerful. If candle size is small, candle is green, and there is ultra high volume, then next candle closes well below that previous buy candle, that is very powerful sign of weakness, and you should sell immediately there. You should place stop loss above there, and you should expect 1:3, 1:4, 1:5 after that. Again, this is a Euro USD chart, 15-minute chart. Market was going up, then suddenly market got the pin bar with the ultra high volume, very high volume than the previous 20-30 bar volumes. Clearly volume is very ultra. Maybe due to some news, then market start ranging. When market start ranging, you with the low volume, you just need to wait for the break below this range with the low volume. If the volume is low, then you should sell there. One sell is when pin bar when this pin bar came in, then next candle engulfing this pin bar, you should take first sell there. You should take first sell there, place stop loss above in pin bar. Now when this market start ranging with low volume, then when it is going to break down, then you should take another sell, and you should place stop loss above range. You will get on both entry 1:5, 1:6, 1:7 easily. So that was a double setup at this situation. Now this is a USD JPY chart, 5-minute chart. There is a buy candle, small size buy candle with an ultra high volume, a volume which is greater than previous whole day volumes, and then the next bar candle closed well below the bottom of previous well below the low of previous buy candle, suggesting that now buyers are not in control. In fact, sellers are in control, and the buy candle have more selling than buying, because when buy candle their ultra high volume suggests that big players were actually selling there, and the next sell candle confirmed that scenario. Okay, now sellers are in control, you should sell there. You should place stop loss above that, and you should expect 1:3, 1:4 after that on that trade. Now this is a USD CAD chart, 1 hourly chart, and you have a resistance to the left side, and suddenly market can break out that resistance. and you saw the ultra high volume pin bar type on this after this breakout, and then market start reversing by engulfing that ultra high volume pin bar type candle, and there was a very low volume on this engulfing candle, bearish candle. That means that the market makers are very close, watching very closely this market. They actually remove their buy liquidity from this place. That is why the sell candles form at this place was associated with very low volume. Now you have to sell there, you have to place stop loss above that, and you should expect 1:4, 1:5, and so on. That was a very powerful setup there. Okay, and if market retests it and that form again a engulfing pattern there with few volume, then you can sell another trade here as well, considering that previously there was another setup as well. So double top type setup, and you got another entry here as well, and you got again 1:3, 1:4 here. Now there is a clear downtrend and market was coming down, then suddenly there was a buy candle with the ultra high volume, and then immediately market dropped back close below the bottom of the buy candle. Now it's a sign of weakness. Clearly market was bearish and you should sell there, you should place stop loss there, but this time we go wrong. Okay, this setup, this very perfect setup got failed. So don't expect every setup to work. You can have failed scenario as well. It's not like 100 to 100 times, 10 by 10. You have to accept that 10 out of 10, 7 will work and 3 will go wrong. It's not like 10 out of 10 will go work. Okay, you will get wrong, your setup will fail. You should expect 3 out of 10 setup to be failed. Okay, you cannot eliminate that probability from the market. Okay, but probability is very high on our setups, but our setup also failed. So you have to know that if that setup came in, then you should use your lot size or position size in a way that you should accept loss if that come on after this setup. Okay, so you should have a planned money management and risk management if you are following this strategy. Thank you, and this was clear to one bar strategy. Simply I call it a two candle strategy. Two candle strategy, where one candle is in a buy side and next candle immediately sell, or one candle is sell side, the next candle immediately buy. So all these scenarios where like this buy candle, then next candle immediately close below the bottom of the buy candle, but that setup failed. Then there was a buy candle on ultra high volume, immediately the sell candle closed below the bottom of sell candle with a low volume, so that was a sell setup. You should sell there. Again there was a buy candle and the next candle closed below the low of previous buy candle, ultra high volume candle, then it was a sell setup. Again there was a pin bar and the next candle closed below the low of pin bar with a low volume, that was a sell setup. Again there was a buy candle and the next candle sell close below the bottom of high volume buy candle, that was the sell setup. And there was a sell candle. You have to wait for buy candle to go up above the high of the sell candle, and then market start arranging. That was a clear setup and evidence that market will go up. Again there was a buy candle, then market gone down with this sell, and that was associated with the ultra high volume. Still you can buy that, okay, you can sell that and place stop loss above. Then market start going up, then there was again ultra high volume, then again there was an engulf, you got second entry as well of sell. So the both entry you have a stop loss above that and you got the nice profits. So that's very simple. You just have to figure out which candle is associated with ultra high volume and just wait for the next candle to engulf or close above the high low of previous ultra high volume candle, just buy or sell there. Okay, that's it. Thank you. If you have any question, I gave you the email me, and also write your phone number as well in that email. so I will help you out if you have any confusion. Thank you.